Good evening. This is the Eye of the Storm podcast, the big picture update for the SPX, the NDX, the treasuries, including the 30-year bond, the 10, 5, and 2-year notes, gold, silver, and the dollar index. I am going to reserve additional commentary on my taking a look behind the curtain for my next podcast, which I again will be doing together with Dan Ascani, where we will go into more detail on our view or what we thought was really happening behind the curtain last week in the market. The markets do continue to react to now the pretty much given conclusion that the Fed is going to continue to raise interest rates for the foreseeable future. We saw that coming in via the federal funds rate, where we saw for the month of March, which will include the next Fed meeting, quite a strong rally in the rate, basically. And so they are pricing in that 50 basis points expected hike in interest rates coming out of that March meeting. And then if we actually take a look at the September contract for the Fed funds, they're pricing it even higher. They're moving that, continuing to move it. So on an additional, if we're going to get an additional 50% or 50 basis point rate hike, what's that going to look like for the month of September? So that did, in a way, I suppose, catch some market players a little bit off kilter there. And so we started to see some stronger seller, and that just continues to give some confirmation and support to my current Elliott wave count for the SPX, and that's where I'm going to begin tonight. So taking a look at, I continue to leave the high that we had in or on February the 14th as the completion point for the minor wave C, and then in turn, the larger intermediate degree B wave. And again, that high was a failure in terms of it did not go up and take out wave 3. So to really put the entire count in, not only is it the minor C wave, but one below, it is the minute 5th wave out of that 5-wave structure coming off of the mid-December lows. So with all of that in mind, I continue to look at the market in that fashion, that we are now in the beginning stages of an intermediate C wave down. Now I'm just going to drop this quickly to my 4-hour chart and open it up slightly so we can take a look inside. So that being the end. And so we had that on the 14th. And then we got 1, 2, 3, 4. So the 3 is actually a little misplaced. It should be right there. I'll just go ahead and change that. I'll just activate it, move it ever so slightly, put it right there. And then the 4 and then the 5 for minor wave 1. Now, as I have been discussing all along, when I am counting a major turn in the market, particularly of this degree and an intermediate degree, what I am now going to be looking for is for the first 5 waves down, pretty much of minor degree, to give a little bit of confirmation and support that that intermediate C wave is underway. Now, what's inside that intermediate C wave will be 5 waves of minor degree. So we maybe have completed that first wave down. I'm leaving open the potential that this 5th wave may still have more to go. When I break it down and put it on the hourly chart, we can see that it gapped, whereas in the futures market, which I'll be updating later this afternoon/evening, it did count down as 5, and it was the gap came prior to, we had the economic data from the PCE, which came in that showed that inflation remained strong, stuck high above 5%. So we didn't get that indication that, oh, the Fed's going to start to back off, ease, maybe go a little bit less, maybe even skip raising for a month, which would mean more of a pivot, et cetera, et cetera. No. And the Fed basically came out during that whole time and was saying, that's not going to be the case. Don't get in love with this rally. That's my words versus they were much more clear on it. But nonetheless, here we stand, got those PCE numbers, and bam, we gapped lower in the future. And then, of course, when the SPX, when the market opened, it showed the gap as well. But I have to leave it open that maybe this was only 1 of 5, this is 2 of 5, and now we're going to continue to go down as this minute fifth wave extends. So I cannot discount additional declines as we begin the week. So while I may be expecting the market to kind of perk up and possibly continue to move higher in the context of a minor second wave. Now, let's just throw up a fib. It's going to be retracements now, right? Because we're just looking for what if indeed that we had Friday's low at 39.43 complete minor wave 1, then I'm looking for an ABC up. And as a minor second wave, or just as a second wave, what would I be looking for? Well, first thing we got to do is we're going to put in the retracement levels. The retracement, so we need to just discount and basically take this larger one out. So let me just kind of get rid of that for the moment, and so we don't get confused. So we haven't even gotten to the bare bones minimum, which is just below that 4,000 level at 39.94. So expecting even more, because the under Fibonacci, when we're looking at Elliott and the relationships between waves 1 and 2, the most common retracement for a second wave is normally between 50 and 62% retracement. That puts it up here. That puts the SPX, the cash market, between 40.51 or 40.50 and 40.75. Now, because of the intensity and the focus now being shifting to not that the Fed's going to ease, the Fed's going to lessen the pressure on interest rates, that now the message we're receiving is that no, we're going to continue to be prudent or stringent in carrying out our plan to tame inflation and to reach their goal of getting inflation back down to 2%. Now, whether that's going to be done or not, that's up to everybody else, not up to me. I have no idea. But I do know that interest rates are going to continue to rise, and inflation does continue to be a problem here in the United States. And the PCE just gave us some confirmation that that's likely going to remain the case for a while longer. So I'm leaving open that possibility that we may turn, and still what we've just got is a small 1 of 5, 2 of 5. We're going to really start to head lower again come Monday morning. If the market continues to go up, if this is the completion point for minor wave 1, then I'm going to be looking for the rally to carry us at least to 39.95. Then we have, prior to that, let me just say, we have resistance at 39.85. We have resistance at 39.95. We have the hourly 50 at 40.20. Then we have 382 resistance on a fib at 40.25. Then moving higher, we have 40.51, which is the 50% retracement. Then we have the 200 EMA and the 200 SMA, both about 40.67 to 40.75, and then right above that, 62% at 40.76. My guess would be is we may not reach that 40.76 if we got up there and these 200s were not, and we're really going flat, then they're going to provide a lot stronger resistance right at that 618 level. So I'm continuing to look, should this rally pick up some steam, that would be like where I feel it would cap out and then turn lower again in a third wave down, which we understanding, if you know Elliott always wrote that the third waves are most often and normally the longest and the strongest out of that impulse sequence of 1, 2, 3, 4, 5, or out of the 1, 3rd, and 5th waves within that sequence. The third is normally the longest and the strongest. So what can I want to say for next week? Again, we're kind of sitting on the fence. Depending on how they decide to do it, we could see an extended 5th wave down, which would put this minor wave 1 not in motion just yet. And so what I'm going to do is I'm going to take out that, and I'm going to go back out to my daily chart. And what we want to look at is, like, where can we start to look for this C wave, right? That's going to be my measurement. I don't really have anything so I can really put down what would that 3rd wave look like, because we don't have the points in which to do it. So I have to go one step higher. So instead of the minor degree, I've got to go back out to the intermediate degree and look at that previous that I just took off. So we're going to put those back on. And again, using the high at the failure level, not this high. So for accuracy, it's like, this is where it failed. That was the C and the end of B, and that's where I'm going to go. So now coming off, we have 0.382. So again, we're trying to measure where this intermediate C wave is going to end up. But I use these internals up here because I actually would not think that the C wave has its closest relationship to the A wave, right? Part of that sequence, this A, B, and now a C. And the most common for a C wave is that it's at least going to be equal to wave A. And that would put us back at 33.25, I'm going to call it. And that would just be if they're equal. Normally, the C wave can be a little bit more destructive in terms of it's going down. And so we start looking for the possibility we can get down here, 31.29, 3,000. Now, remember, I have discussed before in the SPX that we have, for the much larger corrective phase, we have support, 382 support, Fibonacci at 29.80. So could this C wave bring us down to that support level in its entirety? My answer would be, yeah, it can. And we have a very strong probability and possibility that that will be the case. Now, what will be finishing there? A primary A wave. So prior, I've been speaking about what we could have possibly been in a primary C wave. That count got kind of scrapped, and now we're into this extended intermediate degree ABC, and it's a double ABC. So off of the high, so it's the first ABC, we had an X, second ABC, primary A, we get a primary B wave rally, which is going to carry the same characteristics as when I was speaking about the cycle degree B wave. It's just we're not even at that level yet. So we have to deal with it on a primary degree. So it won't be quite as large. It's not going to be covering as much territory, but it should still carry the same characteristics and personality that I would look for within a B wave. Now, we're just changing the degree of that expectation from cycle down to primary. So that would go with how I change the labeling within that primary A wave, which again is still in play. So having that come down to this first major support on a Fibonacci basis for the larger supercycle wave 4 correction within our market, within the S&P, that this would be a very good place for primary A. Then we get a primary B wave rally, a primary C wave decline, and that again would likely bring us down to some of these lower levels. Then we get a cycle wave A. Then we do another cycle wave B. So now you're going to see that I've been discussing all along that because of the large move that we had in terms of the supercycle wave 3, that the correction is going to take some time to unfold. And now we're starting to pick up that we're getting a little confirmation that that's likely going to be the case. this whole period of inflation is nowhere near being contained. So therefore, we have to consider that the whole process is going to take much longer than what I think people were expecting, or investors or traders or whomever were expecting. So what we've got going on here is that we need to just pay attention to where we're going in terms of primary wave A, primary wave B, and then primary wave C. I have to shrink that picture down. I can give some guesstimates on what these things should look like, but we're not going to know until we get our points where we can put in additional fib either for a primary B wave or a primary C wave. We need our points of the previous waves being complete in order to get retracements and or extensions. So for right now, the big picture continues to suggest we are within the beginning stages of that intermediate C wave down. So we're going to be looking for a little clarification from the market, and I think we'll get that tomorrow. We'll get that at the beginning of the week as to whether this actually is going to hold until we can get up and complete a minor wave 2, or are we going to continue to extend lower in the context of a minute 5th wave? Now, if that's the case, then if I had to take this, and again, I'm going to remove that, and I will take one guess. If this is only wave 1 of 5, and this is 2 of 5, and we turn immediately without producing a new high above 39.78, 79, then I'm going to go back and I'm going to play against the fibs. And that would suggest that a third wave, we're going to dip below 3,900. So from where we are, we could drop 80 to 100 points. Even if on a wave, a wave 3, a minute wave 3 of 5, third wave, sure, we can get all the way down to 38.80. We got 38.50 down here on the bottom, 1.618. Is that so far out of reach? Not really. Not really. If we could continue to get confirmation via the economic data that's due out next week of the seriousness of what inflation is doing to the economy, and now it's getting more reflected, then we're going to see a lot of downside. So we do have that potential. Now we kind of got a picture of where we can go if the market continues to head lower. We'd be looking for a third wave. I think minimally, we're going to be looking for it to come in below 38.99, because that is where wave 3 would be equal to wave 1, acceptable, but I'm always looking for wave 3 to be the longest and the strongest. So I'm going to maybe look for a little bit lower, maybe 38.80. That takes care of it. We move, put a little 4, then a 5, and maybe that brings us down to 38.50, and then we start to maybe put in a little bit larger of a rally in terms of a minor second wave. Now that's out there. I'm not suggesting, I'm just saying what I'm trying to read here into what this pattern reveals in terms of what potential the market has for the coming week. Now, moving averages all continuing to be lined up, and as you can see, everything's now back below. We have the 200s, the 50, the 20, the 8, and the 4 in alignment to continue to go down, and that's on the hourly chart. Just taking it out to the daily chart, we see we have broken below. I'll move this up. We've broken below and closed well below the 200 EMA, the 50, the 4, the 8 are heading down to break below those. This would create a little bit more sell pressure if they start breaking below with the 20 following closely behind. And if that all breaks up, then the daily becomes more negative and suggestive of a continued decline. Right now, thus far on Friday, we came down, or the markets came down and gave a peak at that 200 SMA and said, nope, and rallied strongly right off of it. All right, so let's go over, take a look at the NDX. Oops, don't need that. NDX is basically telling me the same story. So once again, on the daily, I still have in place where the NASDAQ cash market also ended in a failure on the 14th. This one would have been, actually, this one came in on the 15th, as it's what it's showing. And where we marked minute 5, minor C, intermediate wave B, starting to move lower. I'm going to come back down, going to go to the hourly chart where I can see that I can count 5 waves down with a very extended third wave. And that has also been equated over in the futures market, which again, I will be updating a little bit later today. So what we have here is again, 1, 2, and then 1, 2, 3, 4, 5 to 3, 4, 5. So I'm putting the minor 1 there. But that would suggest, as previously that we just said in the SPX, a stronger rally. And I can just eyeball and tell you that we're going to have resistance. Well, we closed right at it, but our next level of resistance would be 12,045, I'll call it, 40 to 45. Then we have the 50 at 12,155, and the 200 at 12,268 to 270. Now, where are we going to put our fibs in? If indeed that did complete minor wave 1. First thing I'll do is I'm going to take that off. Then I am going to move this over and just put in our fibs, just a retracement. And I just want to make sure I get to the right level. Yep, it's this one. We'll go there and to there. So again, most common for wave 2 on a Fibonacci basis, it retraces between 50 and 62% of that first wave. That puts us back at 12,295 to 12,390, I'll call it. Now, if things are so hot and heavy in an interest rate perspective, do we think that the market could pick up the steam and really kind of take itself back there? Well, yeah, the NASDAQ, it can. And go definitely contra to what really reality is telling us with the market. So I have no idea what the catalyst would be. But we've seen the NASDAQ, we've seen the S&P do some pretty strange things on catalysts that we would not expect from that type of a reaction. So it could be from volatility, it could be from the bond market turning around. And I'll discuss that in just a moment when I finish here and I go over to the interest rates. I will tell you that we continue to have the possibility that they may just kind of continue to bop lower, and I'll show you how, but we still might get that rally. And that rally to put a finishing ABC in the treasury markets. I'll discuss that in just a moment. Now, if that were to occur here, then yeah, I would expect that we can get a beautiful wave 2, bringing us all the way back here, possibly even a little bit higher. So that potential remains out there, as does that this only truly completed. It's that the fifth wave, the minute fifth wave of minor wave 1, remains in process. So if I'm going to put the 4 there, and then I put 1 of 5, 2 of 5, maybe 3 of 5, 4 of 5, we got 1 more down. Now, if that's the case, I can take those off, right? Actually, no, I'm going to put those back on, excuse me. Those can stay on because now I'm going to add to if inside here. So if I got the 3rd and that's the 4, so what I want to do is go from what I'm measuring as 2 down to what I'm calling wave 3, up, oops. We got to switch it around. I'm going to be putting, excuse me, the extension. So we're going to go from there. Okay, let's try that again. Come on. Everything getting in my favor. Thank you. And we'll put it over, I believe there, up to there. And then what we have is 1, 2, and that's a 3, and that's a 4. I can do 1 more to get where a 5th would be, but we're looking at 11,900 down to 11,805-ish. And then again, we might get, if this is going to be 1, 2, 3, 4, 1, 2, 3, 4, a 5, bring us right down to 11,805, and possibly just below at 11,090, 890, excuse me, 11,890 down to 11,800. If we really kind of get this additional downside going, we could drop quickly, and the S&P can do it really, not the S&P, the NASDAQ could do it very quickly. So we have the continued downside potential, but I would be looking for, excuse me, that we're going to get a bounce in here. And it's going to come in the way of a second wave. So I'm going to leave that right there for right now. And again, I just want to take that off. Nope, I don't want to duplicate it. I want to remove it and do it twice because I duplicated it. So again, on a wave 2, we got our levels. If minor wave 1 is not complete, we've got our levels down to about 11,800 to complete it. And then still we'll make adjustments to the retracements. So wherever this wave 1 doesn't manage to put in its low, then we'll put in retracements to, again, give us the levels we would expect the market to do. Now, that may coincide very cleanly with the interest rate market. So let me go over to and start there, and then we'll move along. In the 30-year bond, first thing I'm going to do is go out to that monthly chart to show you nothing really changing there. But here we go. February the 24th, on Friday, the yield on the 30-year bond was 3.93. So basically, it's sitting right at 4%. And I kind of expected that that's where it was going to head on this particular move. But we're getting to a level where this bond, along with the treasuries, need to kind of find the support and hold it. Because as I've been describing here in the interest rates, or treasuries, that if we did 5 waves down, I labeled it intermediate wave A. We're looking for an intermediate wave B, of which I believe I'm leaving this as a minor wave A, and this being all part of minor wave B, with still leaving a minor C wave, which would be a rally, which would take us higher. Now, how are we intending to do that when we're being confronted with, oh my God, rates are going to go higher, and you're looking for rates now to dip, to go lower while the bond prices go up? Well, yeah, that's what the pattern is telling me, but does not necessarily suggest that we're going to get it. Because the other side of that coin would be is that there's now so much pressure on treasuries to the bond prices and the treasury prices to decline, and the yields or the rate to go up. So that would suggest then that this whole ABC intermediate B wave could be complete here. And this is all suggesting that we're heading lower. Now, in the 30-year, it's not as clear. So what I would suggest from here is that we are still in the minute C wave down to complete the minor B wave. Now, we went down, and I said before, we were looking at that 124.11 area as being fairly strong support. That got broken. And we dropped down close to that next level down, which would actually be 123.08. That's on my larger fibs. I had a lot of internals that brought us right into 123.20, which is where we kind of bottomed midweek, 123.26. So we're not pushing too strongly below that 124 level, but we can. We could have this coming in as again, a C wave. We got a 1, a 2, 3, that's a 4. We drop again, but we end up still not breaking down, but maybe get down to 123 to 121, almost 122. And still, that can complete, excuse me, that could complete the minor B wave. Then we get that minor C wave, which I believe could happen very quickly, very quickly. like a very quick rally back up and an intense rally. And then we're done. ABC's done, and then we just start to slide. Because again, remember on my little bit larger picture, what am I looking at here? We've already done our first 5 waves down and labeling it intermediate wave A. Now I'm looking for an intermediate B wave, which will consist of a minor A, B, C. So that B wave would be expected to get itself above 135 and maybe even as high as 146. Before we get a destructive C wave in terms of bond price, and also destructive in terms of yields would go up, and they would go up fast, and they would be very consistent. Now, there's enough out there to create both situations where we would get both moves. So that's why I'm leaving that all as possible out there. So again, in the 30-year bond, on Friday, 3.93, so basically 4% in the 30-year. Let's go down and take a look at that 10-year note. So again, just to finish up in the 30-year, it has the potential, again, where it could go back and even dip a little bit lower, getting itself closer to 4% or just over 4%, and then stop and put in a rally. It could. Again, when we're looking for what's going to be the catalyst, going to be hard pressed to find one. When we have so much discussion and so much talk about Fed funds, and pushing higher in terms of the rate. 10-year note, same deal. On Friday, closed at 3.95%. That was the yield for the 10-year note. So we're just also sitting at 4%. Now we had looked at the 3.5 was so far the top side level for the first leg up. So we've gone full bore here. Now I'm going to bring this down quickly back to that daily, because here we have the same thing, an A to B, and we got a 1, 2, 3, 4. We're going to get a 5. Could it dip just below, or could it really just go into this slight black hole and end up somewhere down 109? Now, again, if we're going back there, what we're going to be looking at in terms of the rate, we're going to be staring in the face into what this bond was at in October, which is 4.25. That would drop us back down to 108, 108.26. So we can call it 109. That's 4.25. Can we go down there? Yeah, we can. And let me just show you again that it could go down there and it's just an A, an ABC, B, but it turns into a flat. That sets us up for that C wave, but we don't make it above 116. Then it'll be like a flat ABC, right? There's the A, here's the B, there's the C, all nice and flat. So that's also out there. That's also possible. And living within the realm of, we are expecting higher rates. Okay, maybe we relax a little bit or something kind of comes along which shows us that maybe we won't get that persistent 50, 50, 50, or even 50, 75 basis points, whatever, the Fed's up to. And that allows the market to kind of recover a little bit here. All possible. Otherwise, if we start breaking below 108.26, then I'm going to be more in tune to say that, again, the intermediate B wave is done. And like the 30-year bond, this one as well has done 5 waves down, which I would be calling intermediate wave A. If this is going to be the completion point for intermediate wave B, then A, the market is showing weakness and rates are going much higher, and they're going to go very fast to get there, because we're going to do 5 waves down and we're going to start it from here. So we'll be starting it from 3.5%. Okay, that's the big difference. This last 5, we started it from 0.69%. So we'll go sliding through 4.25 like it was butter, as they say. So that's kind of what we're looking at in the interest rates. And that actually together is kind of putting a scare into equities. You would think, what are we going to do? And also producing a stronger rally that we're getting in the dollar. So again, they're all intertwined and they all react. Again, remember at the top of my pecking order are interest rates. What happens there affects everything else. Everything else under that level has to react and gets affected by it. So again, over in the 5-year note, we got the same deal. Let's start over and let's take a look at where this thing went to. So on the 24th, which was Friday, the 5-year note closed at 4.19%. Okay, so here we had down here at its low, 4.45, so almost 4.5%. Well, now we're pressing against almost 4.25. So, all right, 4.20%, basically, and we're only there. So if we get back here, that is going to signal, all right, so the 20th, 4.45. And we're not that far away. So we're hugging what I would call our last major support area within, now I'm going to go back out to my daily again, right there. And that is a fib, and the fib is 70.5% retracement of the rally. That's kind of our last line in the sand. Now, you know, the 10-year note last on Friday, it threw a nice rally and then just backed right off of it. So we're in this state of like, okay, are the lows in for right now? And we are going to put in the C wave? It's too early to tell. If we continue to get a solid rally, then yeah, I'm going to look for a C wave up. And I'll put a B down here. If not, we do run the risk of dropping down to the 105 level on the 5-year note basis, the price basis for the note, and the yield would bring us back to what was that I say, 4.45? Yeah, would bring us back there. And then if we hold that, then again, like in the 10-year note, we would then turn to an ABC flat. And so we'll just be trading in a multi-month-long box. Because again, I'm not looking for the rates to be all done and we're just all, everything's rosy again. If nothing else, I'd be looking for them to continue to break down based on my count. We're just in a B wave counter trend move. And that, counter trend in the yield, counter trend in the treasury or the note price. So one last, the 2-year, which again sits front and center. And this 2-year note closed on Friday at 101.257. The low was 101.237. This low of the wave A was 101.183. Now, what is that level? Let's go out to the monthly, and I'm going to tell you that level is 4.78. Now, beginning of the month, have we put in our 50 basis point hike? We sure have. They're looking for 50 basis points. So this could hold because that's all we're looking for. It might dip a little bit more. Or if the pressure continues to build, as we're seeing in the Fed funds, they may continue to push. So again, we're at a level where we could stop and we could put in a rally. I don't know how strong that rally is because it's questionable as to what rates actually will do. So, but as far as pricing in a 50 basis point, well, yeah, we're 2 pips away for it to being exact. So we're pretty dang close in the 2-year note to pricing that in, which is why I think we saw a little bit of a rally. All right, over in Gold. It continues to present not as clear of a picture as I would like, but excuse me, I'm continuing to leave this as a minute wave 1. And I'm going to leave that minor 4 there. So we're still like in the first leg up of a minor 5th wave within whatever's coming above it. I'm not going to even go there right now because the market is dealing with continually being hammered lower. So again, I went back and I readjusted my fib levels using the candlestick. So it's the extreme highs and the extreme lows that are now reflective and not the closes. And within that, on Friday, we came down and we touched on the daily chart the 200 EMA. Held it, but we'll see how strong that gold wants to get here. With the dollar rallying it, so we get the dollar euro, we got a lot of stuff going on, we got interest rates, et cetera, et cetera. And so a lot of the reactions are due to what's actually happening in the interest rates and within the currencies. So, but we have continued support down below, and that would only be 382. And if this is a wave 2, this is the zone we'd be looking for gold to kind of drop into. Now, it's pretty impressive that we got up to 1975, and on Friday, we were at 1815. It's 160 points, $160 lower pretty quickly. So we have 17 or 1800 next up. Then we have this again off our daily chart. We have the daily 200 SMA at 1783. And then we have the 50% fib level at 1745, the 618 at 1690. That continues to be the zone where where I believe that we'll find stronger support for gold to put in a bottom and start to rally. Again, silver also, unconvincing in any rally attempts. And again, we're counting a second ABC. So is this A, is this B, and this is a C wave? Could be. Is this 1? Is this 2? Doesn't really look like it. So have we reached that bottom of an ABC? Are we of an A wave and going to do a B wave? Everything is out there. The market's going to tell me, but gold and silver remain under some pretty intense pressure. This is our daily chart, and we've just broke and closed, not by a whole lot, but broke and closed below the daily 200 SMA. And we reached fib 382 support at 20.92. And the close on Friday, give that back, was 20.87. So it's not looking real good. Now, again, stronger fibs, 1972 or 73 down to 1854, 55 down to 50. Those are the zones that I'm expecting this to kind of drop into before we get stronger rallies. Many different factors can turn these things around. There's enough going on in the geopolitical world. There's enough going on in interest rates. There's enough going around all over the globe that could suggest either way we're going to go. Right now in gold, we continue to see central bank purchase. Central banks around the globe are stepping in and purchasing gold. And whether it's going up or whether it's going down, they're stepping in and they're buying it. And they're buying it. The major, right now, I would say some of the major purchases are from central banks around the world. So again, a little bit longer term, rallies, I think, are going to be very contained, but doesn't mean that we can't walk in, and then silver's going to go up 50 cents, maybe even $1. That would be pretty strong. But I think that we'll continue to find strong resistance at about the $22 level, $22.25 level, up to $22.50. So, getting even back to 23, which would be a pretty nice move for silver. You got a lot in between that's going to say, nope, this is as far as we go. So last on the list, but not least, we have the dollar index. Oops, that didn't work. Let me try that one again. Dollar index is following accordingly. We're looking for this rally. We're now inside this rally. Again, we rallied and closed above 105 on Friday. So what can we look towards? Again, I'm counting, if this is an A wave, let me just put this up just a little bit so we can see. And actually, I'm looking for another A, a B. I don't know if that's all the B, and if we're going to get a C wave, we're going way beyond here. But a lot, again, depends on what's going to start happening in the interest rates. If interest rates are intending to just kind of mellow out, we get this 50 basis point hike in March, and they start to mellow out, maybe we get up into the zone that I was talking about, but this turns into an ABC, and then we get that bigger rally. So all things work with each other in terms of how these moves unfold. And if the interest rate markets are kind of being iffy in terms of, well, you know, we could bottom here, maybe put in a little bit of C wave rally, I'm going to be looking for the same thing in the dollar, except it's not going to be a rally. It would be a decline. So again, opposite, right? If the rates are going to relax a little bit and start ticking down, so bond prices start moving up, I would expect the dollar to be sold. But I think in between that time, we have a very strong possibility of getting above 106 to 107, the top side of that, before we do get an additional leg down. So if this is going to end up being A, and then we get a B, normal B wave, 108.75 to 109.50. That would be quite the move when we were, you know, just a few, well, at the end of January, we were testing 100, or as they say in the market, par. We were testing par. And now we're going to start pressing on 108, 109. That's pretty impressive in a month. But it is very possible. It's very possible. Again, enough geopolitically happening, enough happening in the country. We've got stuff going on here, folks. They've not even, I don't think they're even having a serious discussion yet about that debt ceiling. We got to get that debt ceiling raised, or our federal government, the government's going to have to stop making payments on something. And if that doesn't shake up the House of Representatives, I'm not sure what will. Since they all are determined they're going to hold power, and they think for some reason that all of their constituents, retirees included, are going to be like, oh, sure, I support you. You go ahead and fight for that, to get all that budget squeeze going. And if they stop paying my Social Security, I'll be the first in line to boot you out of office. And that's what I personally think. But we shall see what the market wants to do. So again, potential here in the dollar is that it continues to move higher to complete, which is likely, in my view, going to be a B wave. So if I put even a minute wave A down here, we're in a minute B wave, which should be an ABC of its own. You know, so I am all right now, I think we're just getting the A wave. So maybe we get up here, we put a little B wave in, get a C wave, finish up, then we drop. And that's, I do suspect during that one, we do get back down towards at least below 100, down towards 98 before we get the next stronger rally in terms of would be a larger minor C wave. So we got to finish up internal A, B, C for a B wave, and then we get another rally. So we got a lot to go for the dollar in terms of internal movement. And it's going to be up, it's going to be down, it's going to be up, and then back down, and then back up. So we got a lot of craziness going on in our markets right now. That's just where I'm going to end it for right now. Again, getting into more detail about getting behind the curtain will be coming up in my next podcast along with Dan Ascani, and we'll be discussing that. And then I will also be doing an Elliott wave update for the S&P 500, the ES, and the NQ. That'll also be coming later this afternoon. Have a great trading week, everybody.